Hey all, today I'm going to be explaining the various different types of mortgages, loans and finance. I'm going to be explaining the difference between a bridging loan, a residential mortgage, a bridge to let and all other different types of loans, and also what's most appropriate in each circumstance. It can be quite confusing as there's a lot going on, so I'll be sure to go into a good amount of detail but also keep it fairly simple and easy to understand, and I'll also be sure to chuck a bunch of timestamps in the description below so you can easily navigate your way around this video. If you enjoy this video or it helps you learn about the different types of mortgages and loans, then be sure to drop a like down below. So to start with, I'm just going to explain a bunch of different key terms that will make this video really easy to understand. Firstly, we have the LTV, or the loan to value ratio. This is the ratio between the loan and the value of the property. So for example, say you had a property that was worth £100,000 and you had a 90% LTV loan. You'd therefore have a loan of £90,000, and therefore the ratio of £90,000 to £100,000 is 90%. Next up is a fixed rate or a fixed period, and this is where the interest rate on your mortgage is fixed for a period of years, 2, 3, 5, 10, or maybe a different number. And after this period expires, your mortgage will convert onto a variable rate. This is effectively the bank's rate plus X%, and the bank can change their base rate when they see fit, sometimes in line with the Bank of England and sometimes not. But effectively when the bank change their base rate, your interest rate will either go up or down, and therefore your mortgage will be more or less expensive. The banks tend to keep their base rate in line with the Bank of England or with the Fed, but not always. For example, say if the Bank of England cut the interest rate, but one of the banks was actually struggling and therefore it didn't want to cut their interest rate because it might make their position worse, they don't necessarily have to, as they set their own base rate. We then have a variable rate mortgage, which is effectively just a mortgage without a fixed period. So you could have had a fixed rate mortgage and then it expired onto a variable rate mortgage, or you could have just chosen a variable rate product from the get-go. And we also have tracker mortgages. These are slightly similar to the variable rate mortgages, but these mortgages track the Bank of England base rate or the Fed rate exactly. There's no changing and there's no deciding whether or not they want to follow any rate cuts. It just automatically tracks those rate cuts or rate increases. The next term we've got is setup fees, and these often come with mortgages when you obviously set up the mortgage and can be expressed in pound term, like a £500 fee or a £1,000 fee, or as a percentage term, such as 1% the value of your loan, or 0.5% the value of your loan, or so on and so forth. There's also ERCs, which are early repayment charges. You incur these when you pay off your loan early, or you pay off your loan when you're still in the fixed period of your fixed rate mortgage. So for example, say if you had a 3-year fix, but you wanted to pay off your entire mortgage after only 2 years, you'd probably suffer some ERCs, which again are usually expressed in a percentage term and are usually 1, 2, 3, usually between 1 and 5% of your entire loan. And finally, we have the repayment format. This usually comes in two forms, either interest only or capital and interest, sometimes called capital repayment. With an interest only mortgage, you only pay off the interest that's charged to you each month and you don't pay off any of the loan. And therefore after 25 or 30 years, you still have the full amount of loan outstanding, and you'll probably have to sell the property or the house or whatever it is to repay the loan. But with a capital and interest loan, each month you pay off not only the interest, but a portion of the loan as well. And therefore after the full 25 or 30 year period, you've chipped against that loan each month and you've repaid the entire amount. So the first kind of mortgage we're going to talk about is the residential mortgage. This is the most normal kind of mortgage, as people use this to buy their personal home. It's probably the cheapest form of mortgage as well, and rates usually range between 1 and 2%, unless you're using a really low LTV, in which case your rates might be lower. Residential mortgages tend to come in 3 different forms: fixed, variable, or tracker mortgages. And the fixed and variable mortgages tend to always have ERCs, or early repayment charges, where the tracker mortgages don't usually have those fees. It's not all a be all and end all, and there might be some exceptions to that rule, but that's generally what I've seen. You can also get these mortgages on a capital and interest repayment or an interest only repayment. However, in the vast majority of circumstances, probably like 98% of circumstances, they usually come under a capital and interest. It's only in very rare exceptions, such as if you're buying a very, very, very expensive property, say 5 mil plus, that you'll be able to do an interest only mortgage. and it will probably have to be specially arranged. This product tends to come with fairly low setup fees, usually between £0 and £1,000, and again fairly low ERCs, probably between 2 and 5%, obviously on your fixed or variable form. These mortgages can only be used to purchase your personal residential property, and therefore they can't be used for property investment. If you were to use a residential mortgage for property investment, I think it's technically mortgage fraud, and you can be blocked from all lenders from ever getting a mortgage again. However, you can use a residential mortgage as part of a property investment strategy, and I teach all about this property investment strategy right here on my channel. Effectively, what you're going to do is buy a house in need of refurbishment and make that your home. So you buy it with a residential mortgage, and then you live in that house while you refurbish it. And obviously you actually make it your home. So you pay for the water and the electricity bills, the TV license, council tax, you register your car there and your credit cards and your bank account, have dinner there, just everything that actually would make it a home. Then obviously once your home is refurbished and you've lived in it for a little while, you might look to move somewhere else. You might look to sell the home and upsize, or even convert it into a rental property and live somewhere else. Now interestingly, there's no guidance on how long or how much time it takes for a property to be classed your home. It can't be measured in days, weeks, months or years. It just depends whether you've actually lived in the property. And obviously if you have lived in that property and that was like your only property, then that is your home. Now the next kind of mortgage is a buy-to-let mortgage. That's for the purchase of a rental property. Now the interest rates here are slightly higher than with a residential mortgage, probably around 1.5 to 3%, but again, probably lower if you're using a low LTV. Now these loans come with fixed or variable rate interest on capital and interest or interest only formats. Now interestingly, most of the buy-to-let loans are on an interest only format because investors are fairly confident that at the end of the term they'll either be able to remortgage or sell the property for more than the outstanding loan. And obviously on an interest only loan you'll be able to maximise your monthly profits, as obviously your monthly repayment is probably going to be about half, maybe even less than a normal residential mortgage capital and interest repayment style. Now buy-to-let loans tend to come with a little bit higher setup fees, somewhere around £500 and £2,000, and also tend to come with ERCs as well, but again there are products that don't have any ERCs. You just have to look around really. These mortgages can only be used for the purchase of a rental property, but you probably wouldn't want to use it to buy your residential home, as obviously it's more expensive. But you also shouldn't really purchase a property in need of refurbishment, refurbish it, and then remortgage onto a different buy-to-let loan, because obviously there you're intending to refurbish the property first and then rent it out later, not to buy it to rent it out from the get-go. If you found this video useful so far, then be sure to subscribe to the channel because I make more useful videos just like these. But what you would want to use for a refurbishment would be a bridging loan. Now bridging loans tend to be a lot more expensive, somewhere around 5 to 10% interest per year, and these loans tend to be quoted monthly, such as 0.5 or 0.75 or 1% per month. These loans are a little bit different compared to most normal loans because you don't make any monthly repayments. Therefore it's not interest only, and it's not capital and interest. The loan interest just rolls up each month and you pay off the entire loan at the end of the mortgage term. These loans tend to only come as fixed rate and not variable or tracker because the loan terms are usually only for 6 to 24 months instead of being for 25 or 30 years. Bridging loans come with even more expensive setup fees, probably around 0.5 to 2% of the entire loan, and they also sometimes come with ERCs as well. These bridging loans you probably only really want to use for a light refurbishment, such as a repaint, new carpet, maybe a new kitchen, a new bathroom. Just something that you can kind of keep to 3 to 6 months maximum, because that way instead of paying 5 to 10% for the year, you're only paying half or a quarter of that. So obviously somewhere around like 1.5 to 5%, and therefore it becomes much more reasonable. Now in the UK we have something called the 6-month rule, although this usually only applies to the sale of properties, because lenders don't really like lending to people that are buying a property that has only recently been bought or sold within the last 6 months, because it can be seen as quite risky. For example, the bank might think that someone's bought a bit of a dodgy property and they're just trying to offload it onto some unsuspecting sucker as quickly as they can. Or maybe someone's trying to manipulate the value of their property by buying and selling it between different people really quickly So, you buy it for 300, sell it for 400, buy it for 500, sell it for 600, and you've manipulated the value of your property incorrectly. Now, this does sometimes also apply to remortgaging. By the way, I just want to quickly clarify that remortgaging and refinancing are the same thing, like football and soccer. They're just different terms. It was just a quick question or a query that I had the other day. And it applies to refinancing because some banks don't like to revalue a property much higher than they revalued it a few months ago, even if you've made some quite significant enhancements to your property. They're likely to just give you a bit of a rubbish valuation and take the value that they valued it at a few months ago and just add 10k on top of it, which isn't really a true reflection of the value of your property now that you've made those significant enhancements to it. So the best way to get a fair valuation and to refinance within 6 months is to use a combo product. These can only really be arranged by mortgage brokers, but effectively you'll get something like a bridge to let loan. This is where you start off on a bridging loan at the initial value of your property, and you do your refurbishments to the property over 3 to 6 months, and then instantly refinance onto a buy-to-let loan, all as part of the same product at the much higher value that your property is now worth. These products do have quite high fees because you're probably paying the setup fees on the bridging loan and the setup fees on the buy-to-let loan and some mortgage broker fees. But it is obviously the best way to get a fair valuation after you've done refurbishments. Be sure to comment down below if you have some questions about mortgages that I haven't covered here today. Also, be sure to watch some of my other videos where I explain other parts of property investing as well. The next kind of mortgage is a commercial mortgage. Now, typically a commercial mortgage is a broad term used to describe any property that isn't your home. But today I'm going to focus specifically on the type of mortgage that you need to buy an office block or a garage or a form of commercial property. These loans are a bit more specialist and you'll probably have to sit down with someone from the commercial lending team at a bank. You'll probably also need a higher deposit, but effectively this is just the same as a buy-to-let loan but for commercial property. These tend to come on fixed, variable and tracker format and come in interest only or interest and repayment loan formats. These are a lot more flexible as well because you're effectively sitting down and creating your own mortgage product rather than just picking a product from the shelf at a quoted interest rate. Therefore, it's kind of hard to estimate what the interest rate will be because the bank take a number of things into consideration before they give you your interest rate. They'll take into consideration what the rent is, when it's being paid, what kind of lease the tenant's on, the quality or trading history of the tenant, and a whole bunch of other things as well. Basically so that they can decide how confident they are giving you a loan. There's also small and large scale development loans. With a small scale development loan, again you can probably negotiate it online and you're just picking a product from the shelf. But with a large scale development loan, you'll probably need to sit down with someone from the commercial lending team at a bank and you'll probably even have your own bank manager. These kind of loans are for the development or creation or building of property, or properties should I say. And these loans can vary in size and interest rate as well. They can vary in size from a few $100,000 to a few $100 million or even a few billion, and also vary in interest rate from between 2 to 6%. These loans also tend to be on fixed or variable rate, probably more likely variable rate, but they won't be based on the bank rate or the Bank of England rate. They'll probably be based on LIBOR or Euro LIBOR, but these are obviously being phased out at the moment. Now I think that just about covers it for the most common types of loans. There are definitely other kinds of loans that you can get, even by registered or non-registered lenders, such as venture capital firms or private equity investors or business angels or anything like that. You can even specialise and customise your loans a lot differently as well, but those probably aren't as common as typical high street loans or just other online lender loans. As always, if you've enjoyed this video, then be sure to watch some of my other videos. Alternatively, subscribe to the channel and ding the notification bell. That way, you'll be alerted when I upload a new video. Cheers!